Hey guys, hope you and the families are doing well. You've probably heard the old saying, history doesn't repeat, but it rhymes. And nowhere do I think this is truer than the tactics that institutional investors use to shake out weak hands and to shake out retail traders. So I'm going to show you in this video what I think are the classic footprints that you tend to see when institutional investors are up to their shakeout games. To do that, we're going to have to dial in the pattern recognition. Specifically, there's 3 candlesticks that I'd like you to be able to identify. They are variations of hammer candlesticks, doji dragonflies, and takuri lines that I call shakeout demand tails. So to help illustrate the point, I'm going to take you through a trade I've had in Kinross gold that you can see is lined up versus Heckler mining, which is back in 1979, just to show it is absolutely timeless. These things keep happening time and time again. And then I'll also show you Meta, which put in a failed breakout and then put in a shakeout and then broke out. So I will be taking you through these charts to illustrate the points. Market Surge are today's video sponsor. They are my go-to resource for analyzing company fundamentals. If you are interested in the offer that you see in your screen now, then you will find a link to it in the description and the comment section below. Okay guys, let's get into the video then. So what we have here is 2 precious metal miner stocks. Now one put in a shakeout demand tail around its 50-day simple period moving average in 2024. The other formed a shakeout demand tail around its 50-day moving average in 1979. So a few years apart, right? So Kinross Gold, I targeted this one through the high of this shakeout demand tail. There's a YouTube video on the channel from a couple of weeks ago if you want a more thorough explanation of it. But what I like to do in this video is keep it specifically on pullback setups to key moving averages, where I look for the large operators to play their usual shakeout games that I'll teach you, and also shakeout type setups after you've seen a failed breakout. So there's going to be 2 types of variations here. One is just a pullback to key moving averages. I'll teach you about what key moving averages I pay attention to. And the other is after you see a failed breakout, look for the shakeout, and we'll do that in Meta. So you take a look here at Kinross Gold. Okay, the stock is in the context of an uptrend and then it pulls down to its 50-day simple period moving average. So where I am looking for these shakeout demand tails to form, which again are variations of hammers, doji, dragonflies, takuri lines, is around one of 2 moving averages. The 21-day EMA being the blue line, or the purple line being the 50-day simple period moving average. I think the 10-day EMA for many stocks, unless they are kind of your momentum leader type stocks, will be too quick of a moving average. So often I find a sweet spot, and you can go and look back at charts 10 years ago, 20 years ago, 30 years ago, 50 years ago, 100 years ago. Go and look, where are these stocks forming these type of candlesticks, these type of setups. I'll show you one of my model books maybe at the end of the video, and I'll just run through them so you can start dialing in your pattern recognition more. But if I'm looking for the pullback, then I'm either looking around the blue line being the 21-day EMA, or I'm looking around the purple line being the 50-day simple period moving average. Now a little nuance here is, and you can see this with both Kinross Gold and also Heckler mining, the low of that shakeout demand tail, I put it in this red zone. Do you note where the low of the shakeout demand tail is? See how it undercuts the last 6 weeks or so of price action. So see how it's marking the low. So it's marking the low, and the volume is this black line here is the 30-bar average. Note that the volume is below the 30-bar average. So not only we're looking for confluences, we're looking for reasons to take the trade. So not only is it a shakeout demand tail off of its 50-day simple period moving average, that's putting in the low that knocks out the last 6 weeks of trading. And the volume's also below the 30-bar average. What does that tell me about supply? What does that tell me about selling at these levels? There's not much of it. So this is one of the footprints that I look for to go, okay, institutional investors, the large operators in the market, they're up to their usual games. Because guess what? I've seen it before. I've studied history. Now these charts are not exactly the same, but if your pattern recognition is dialed in, you're probably going, there's a lot of similarities there. There are a lot of similarities there, even though one is from 2024 and one is from 1979. So if you look at Heckler mining, okay, it's in the context of an uptrend. It builds this Davis box. It then breaks to the downside. As it pulls back into its 50-day, you get a little shakeout demand tail, little shakeout demand tail, really nice shakeout demand tail, volume below the 30-bar average. And note how the low just undercuts the last 4-6 weeks of price action. Drew that badly, didn't I? In this red zone in here, I drew that badly again, didn't I? But you understand the point that I'm making. It's a confluence. Okay, pull back to the 50-day simple period moving average. That is a region where I'm looking for large operators to step up and support the stock, play their usual games. So the 21-day EMA, the 50-day simple period moving average, that's a reason. That is a region where I'm looking for the characteristic. I'm looking for what I call gap down reversal bars or shakeout demand tails. I'm looking for visual evidence that large operators are stepping back up and supporting the stock. Okay, in the form of buying, in the form of shaking out retail traders, shaking out weak hands. And the fact that it just undercuts these lows here, this red zone, imagine if you were trying to get positioned in the stock here. Right, in 1979, I wasn't trading in 1979, doubt you were either, but imagine if you were trying to get positioned in the stock, you're like, it's building a nice Davis box. Where would you put your stop loss? I don't know, probably somewhere just under here, just underneath the 21-day EMA, that shakeout demand tail has knocked out your stop loss. Okay, same with Kinross Gold. Anyone with a realistic stop loss that's pretty tight, trying to get positioned in here, maybe you were riding it here, okay, maybe you've exited there, maybe you've exited there on a break of the 21-day, maybe you kind of put your stop loss in here and you just got knocked out there. But you see what I mean by it is really shaken out weak hands over the last 6 weeks or so, and any traders that were maybe positioned in it had ridden this up and then are like, oh, this is rolling over, I'm out, and then it resets and off it goes again. And then it also builds quite a nice little pivot afterwards. Maybe you can add, maybe you can't add. Okay, and here as well, builds a nice little pivot. This is a framework that I call pop, test, reversal. Okay, so here's the pop, here's the test, here's the reversal. What I try and do in my own trading is free roll into the pop, sit through the test. Maybe I can add. Those of you who watched the channel for a while may recognize that bar. Okay, trigger bar, I call that. So low volume inside bars around key moving averages like that. And then it tightens in here, there's the test, and then off it goes. So then you're building out the mental representations for not only the setup, but what you expect to happen after the setup. Okay, looking for a pop, looking for a test, looking for a reversal. How am I going to look to optimize the profits? Selling rules, selling guidelines, both in terms of monetary gain, but efficiency of the monetary gain. What are you going to use as trading stops? 10 days, 21 days, maybe some back for the 50, gets extended from the 10. You're going to be looking to choke it off. But hopefully that there gives you a flavor for the type of things to look for. Okay, so this is just a straight pullback buy, more so for the 50-day simple period moving average. So I'm looking for a variation of what I call shakeout demand tails. Even better if it undercuts, okay, the last 4 weeks, 6 weeks of lows or whatever it may be. Even better if the volume dries up as well, because it tells me there's not much supply, there's not much selling at these levels. And then a nice strong reversal either off the 50-day or maybe it undercuts and then reclaims, but then closing above the 50. That there can lead to quite a attractive setup in my view. So next one, I'm going to take you through Meta. Okay guys, let's get into the meta chart then. So the context here is going to be a little bit different, because this is going to be a shakeout after a failed breakout, which rhymes, doesn't it? So we're going to talk about this V-shaped breakout, how there's a shakeout 2 bars afterwards, how it sets, and I target it through the high of the bar, and then it goes the second time. So the context here is a bit different to Kinross Gold. Kinross Gold was more of a pullback to the 50-day simple period moving average, where what we see here with Meta is the stock is basing, arguably kind of Davis box-esque, isn't it? Okay, there is a breakout failure, shakeout, and then the stock goes the second time. Speaking of Davis, many of you may have read his first book, How He Made $2 Million in the Stock Market. About 10 years later or so, he actually wrote another book, and he significantly, I think, changed his rules. He would not buy the first breakout from a Davis box. Now, why did he decide not to buy the first breakout from a Davis box? What he found, and this is back in the 1970s and 1960s to an extent, is he kept getting shaken out. Okay, he was buying the first breakout only to get shaken out and see the stock go the second time. So then he decided, I'm going to make a rule. I'm not going to buy the first breakout, I'm going to buy the second breakout. Interesting, right? So what we see here is we have a V-shaped breakout. I don't know why you'd be chasing a V-shaped breakout, followed by this shakeout demand tail. We'll come on to the shakeout demand tail in a couple of minutes time. If you were buying this V-shaped breakout, I don't know why you'd be buying a V-shaped breakout, but if you were, where would you place your stop loss? Well, there's probably three logical places. Maybe you go lower the day. In here, you go lower the day, maybe you go underneath the 10-day EMA, or maybe you go down here a little bit lower, kind of underneath the 21-day EMA and this bullish bar, right? So if you place your stop loss at 0.1, 0.2, or 0.3, and you were chasing this V-shaped breakout, you just got stopped out of your position, right? Which is the point. So Meta, it's very, very obvious, this breakout point here. There's probably a lot of alerts set just there from breakout traders to buy it there. What do you notice about the volume on the breakout? There's not a great deal of it. It's below the 30-day average volume. What do you notice about the volume on the second breakout? Interesting, right? A little bit different after you get the shakeout coming through. So V-shaped breakout here, okay? No real volume, no real institutions buying that to kind of my eyes, because you're just not seeing the volume. You're just not seeing the commitment of buyers like you are seeing here. Okay, volume may be 1.5 times the 30-bar average on that breakout there. But my point here is you want to be aware of yourself. You want to be aware of other traders. Okay, so you want to have that awareness of, okay, what are retail traders doing? What am I doing? What is large operators doing? Are they trying to shake out weak hands? Are they supporting the stock? Are they not supporting the stock? So what I think is when you get these failed breakouts followed by a shakeout, I think it's a very constructive sign to see, because I think large operators are showing you their hand a little bit. Okay, they're showing you their hand. This was not retail traders trying to shake out retail traders. It just doesn't work like that. Okay, they do not have the buying power. They do not have the intelligence, the savvy to be able to do it. So when you get this failed breakout, and then in Meta of all stocks, okay, to then put in this shakeout demand tail 2 bars later that nearly undercuts these base lows, undercuts the 21-day EMA, undercuts the logical stop loss places, I do not think that is coincidence. Like, I do not think that there is coincidence, nor do I think this shakeout demand tail over here back in late May that undercut the last 3 weeks of lows, say, before the stock then just started running out, I do not think that is coincidence, that you see the shakeouts before the stock runs. You see the shakeouts before the stock runs. So I like looking for the shakeouts, certainly in the mega caps. Now, similar point to Kinross Gold, I think a real sweet spot, certainly for your mega caps, the vast majority of stocks, 21-day EMAs and 50-day simple period moving averages will be a sweet spot. Oftentimes, the 10-day EMA will be too quick. You can see a shakeout demand tail here for Meta around the 10-day EMA. I think it's too quick. I think better ones are 21-day EMAs or 50-day simple period moving averages. But hopefully this is something to be thinking about here in terms of the context, in terms of the psychology. Who's doing what? Where are breakout traders? Where are retail traders? What are institutions up to? Have they just shaken out? Have they just shaken out retail traders? Weak hands? Has that shakeout demand tail just gone through a very obvious stop loss location? If you think about the low of this one in this red zone, imagine if you were trying to get positioned in Meta anywhere in here like this, right? And then that bar there just shakes you out and then it runs. Like, I do not think that is coincidence. That is planned, that is executed perfectly by large operators. I do not think anything random happens in the stock market, certainly when you're talking about the mega caps, the Metas, the Nvidias, the Microsofts, the Amazons of the world, okay? It is large operators that absolutely dominate those stocks. This is a Wyckoff principle as well, the composite operator, thinking about all the stocks movements are controlled by a single entity. What is that entity trying to do? Now, it's not controlled by a single entity, but it's a useful framework to be thinking through. Okay, so just to wrap this video up then, if you are a member of my platform, you'll see that there are various model books available. So you can go and look at trigger bars, you can go and look at shakeout demand tails, you can go and look at gap down reversal bars, and you'll see lots of historical examples and recent examples as well, really to just dial in your pattern recognition. I think when you're studying the charts, hopefully that opens your eyes up a little bit to the psychology. So thinking about when you see a shakeout after a breakout failure, thinking about when you see a pullback to a key moving averages, 21-day, 50-day, seeing a shakeout demand tail, gap down reverse bar, undercutting the last 4 weeks of lows, the volume drying up quite nicely. So if you're a member of my platform and you want to go and take a look at those model books, you go to the start here section and then you'll be able to find them. So that is it, guys. I'll wrap it up there. Thank you very much for watching the video. Thank you very much for supporting the channel. And as always, I look forward to seeing you in a future video.